Thank you for joining our Q1 Manufacturing Outlook webinar today. I'm Richard Austin, BDO's National Head of Manufacturing. For our webinar today, we're delighted to be joined by Make UK's Director of Policy and Engagement, Ben Fletcher, and their Senior Economist, James Broom. Ben and James will be providing an update on the state of UK manufacturing and sharing the findings from our latest Manufacturing Outlook report, which was launched yesterday. We're also joined by some BDO experts. We have Chris Marsden, Jenny Shutt, and Stephen Cooney, who will be providing an update on turnaround in the manufacturing sector. The presentations will be followed by a live Q&A. Please submit any questions you have through the Q&A functionality, which I think is on the right-hand side, and we'll pick these up at the end. But with that, I will hand over to Ben at Make UK. Over to you, Ben.
Thank you very much, Richard. And I've just realised that Ben and James sounds like a slightly dubious knockoff ice cream firm. So we'll need to work on that. Maybe we'll bring some product to the session. Thank you very much. We've got a very interesting update to take you through. James will run you through the kind of detail of the survey and the analysis and our views on what the sector is looking like at the moment in what has been, I think, a particularly challenging and tumultuous start to the year. Before he does so, I'll just give a very brief overview of some of the contextual issues and the things that Make UK have been particularly active on in that period of time and in the period of time immediately beforehand. Inevitably, we can't use the word Brexit anymore, but this period, when we look back on it, is very heavily influenced by the agreement on Christmas Eve of the Trade and Cooperation Agreement between the UK and the EU. And I think the combination of the lateness in the year and the very limited amount of time to prepare for those new arrangements, the kind of very big crunching gear change from the end of the period of transition into a very different trading environment has both practically and I also think in terms of kind of the wider context and the wider impact it's had on the confidence and the awareness of manufacturers thinking about some of these issues. That's had a really big impact. Certainly we're hearing that anecdotally as well as in terms of evidence. The really big challenges that have become very apparent have been those faced by people who are only exporting to the EU, aren't familiar with the processes involved in completing customs paperwork and so on. Some very complex arrangements for the trade between mainland GB and Northern Ireland. And in particular, I think the thing that is really coming through to us is the complexity around rules of origin and the need for goods to have a 55% domestic or EU content to avoid the imposition of tariffs. A range of challenges around that, including both understanding that threshold, both once you have understood it, being able to articulate it accurately on the paperwork, and certainly for many exporters, how you go about starting to assess whether or not you are 55% UK or EU product if your suppliers don't actually have that information to hand, if you've never asked them for it before. So actually completing accurately that calculation is exceptionally difficult. And what we're beginning to see really is exporters falling into three groups. Those that can complete the paperwork and feel confident to do so and have managed to get over the very high wall that's just suddenly been constructed in front of them. Probably the largest group are those that haven't yet managed to do so, or at least not do so consistently, but who probably will get there in the end. And I think the third group are people who are really struggling to overcome that challenge, in particular firms who act as effectively a logistics hub across the EU, who are frequently importing, exporting and re-importing stuff as the good is produced or as they bring orders together from different places in Europe. The rules of origin calculation is making that very difficult, because if the EU has a trade deal with a third country, that good is fine for circulation once it's in the EU. If it leaves the EU to come to GB, it then falls outside that 55% rules of origin calculation. So taking it back into the EU again is very hard and doesn't fall within that requirement or doesn't fall within that calculation. So we're finding that people who are running logistics hubs for EU trade are finding it increasingly difficult to make their business model work. Clearly, COVID has been another really challenging issue. Government support is there, but sectors where demand has fallen through the floor, aviation and automotive in particular, are continuing to struggle. And many businesses are also just about starting to come out of, but had real challenges at the start of the year with keeping their workforce active and in the workplace because of the need to self-isolate, the range and rate of infections at the beginning of the year, and those things all had a marked impact. Final contextual point is one that came towards the end, which is the budget. Stephen Phipson, our Chief Exec, and I met the Chancellor a week or so before the budget to make our case, but also to get a sense of where the budget was heading. We, broadly speaking, have welcomed the super deduction. We think, even though, because it's only available for a relatively short period, it might not necessarily create a tidal wave of new investment. What we think it will do will be to encourage those who are having second thoughts about investment to do so and to go ahead. And we think that that will then have a catalytic effect through supply chains and build confidence. What we have said to Treasury is that it is slightly unfortunate that many large firms now make capital investment through leasing programs rather than outright acquisition. And the scheme as it's currently configured doesn't give that incentive for leasing. Clearly, the company that actually makes the product in the first place may be able to get the benefit of the deduction. But for the people who are actually spending the bulk of the money, if they go down a leasing and servicing option, which is a growing segment of the market, it doesn't apply. So that's one of the few disappointments we've got about that scheme. We're pleased about both the consultation and the slight increase in the R&D tax credit. We're pleased with the arrangements around Help to Grow, and we think some of the issues around high quality management training are really, really positive. Our biggest concern, which goes back to our issue around investment, is about the decision to end the Industrial Strategy Council and what at a hard edge looked like a real end to the industrial strategy. What we're starting to get signals from government, though, is that there will be an industrial policy to replace the industrial strategy, a much bigger role for the Treasury in setting that, and some indications that things like sector deals will carry on, all of which is good news. But nonetheless, our big fear is not that the absence of an industrial strategy is something that SME companies suddenly fall over because it doesn't exist, but actually the real benefit of an industrial strategy was for larger firms, for firms who've got particularly international parents or large investors from overseas. It set a very clear plan and a clear commitment for manufacturing that was going to unlock, I think, a large amount of investment. And what we need to do is to work with government very closely to make sure that the industrial policy that will replace it can perform the same function, and that the exchange between government and manufacturers can continue to be rich and useful and mutually informative. So that's our kind of big contextual stuff. I'll now hand over to James, who can take you through the conclusions from this quarter's analysis.
Thank you very much, Ben. Well, I have to say this afternoon, I'm relieved to say that for those of you who have joined us before, this will be the first quarter in over a year that I'm going to be able to bring you some relatively optimistic news in this lunchtime period. So for this first quarter of research in 2021, this is obviously a period where UK manufacturers are still grappling with the challenges posed in the later stages of the pandemic, but it's also, more crucially, the first period of research where the UK has completed its exit from the European Union proper. This piece of research had a sample of 314 UK manufacturers, which is a good size sample for this type of quarterly research. And the results are really showing some very encouraging outlook for the sector, really suggesting that the consistent negativity in almost all of our metrics has come to an end, and we may be looking at what will transpire to be the end of these consecutive quarters of loss that were sustained throughout 2020. However, it must be caveated that these figures are now coming from quite a low base, having had that same 4 quarters of negativity. So the optimism should be tempered somewhat. However, the boost in confidence that we've witnessed to go along with our increased positivity on our metrics is hard to conceal. And there does seem to be a significant light at the end of the tunnel now, moving into 2021. I'll go into some overview points now. But it must be mentioned that this generally speaking, before I get deep into it, we did not really expect to see this, to be quite frank, until about Q2 or Q3 this year. In Q4 last year, manufacturers were reporting that it's very, very unlikely, given the sort of social political environment of Q1, of we're still going to be quite knee deep in the pandemic and lockdowns, but also it's going to be the immediate aftermath of the end of the transition period, that it's going to be very unlikely that Q1 is going to see any positive figures. Yet here we are, having done the field work, and the figures are remarkably positive given the circumstance. So output volumes are up, with an even greater improvement expected next quarter. The same can be said for UK orders, which are up, with a greater improvement expected next quarter as well. Now, export orders remain negative, which is not surprising and was to be expected. And this is arising from businesses both in the UK and EU yet to settle into the new UK-EU trading arrangements. But expectations for export orders next quarter stand markedly positive in contrast, which lends weight to the story that this is a temporary blip more so than a new systemic problem with trade between the UK and the European Union. UK market and export market prices have both indicated improvements, although UK market margins and export market margins remain in decline. Employment figures remain marginally negative, but exhibit a reduced negativity than last quarter, and next quarter expectations suggest growth in employment by the second quarter of this year, so next quarter. And finally, investment remains in marginally negative territory, although the negativity is roughly as half as severe as it was last quarter on balance. So if our metrics haven't gone positive in certain aspects, they're significantly less negative than they were last quarter. So the trend is certainly upwards, and largely in line with the Office of Budget Responsibilities revisions that have upped their forecast for both the wider economy and UK GDP. We've revised our forecast more significantly for manufacturing output, but also for overall UK GDP. And the gap is now closing between the rate of manufacturing economy recovery and the wider UK economy recovery. I'll go into some details now on some of those metrics. So if we could have the next slide, please. Thank you. So we see here, and this will probably be the last quarter I do this, but we see the global financial crisis ghost bar on the far right, and that's just to give a sense of scale as to where we were, because we can see in Q2 last year, minus 56 balance, that we actually recorded worse figures than we recorded in the GFC. But we see now that we're above the parapet of positive figures. It's certainly not explosively positive, but if you look at the rate of change of our figures in between those three quarters, going from minus 56 now to positive 9, that's certainly a welcome feature so early in the year, especially as I mentioned in the first slide, that in Q4, manufacturers were not expecting to see positive figures in Q1. It was certainly going to come. The recovery from such a low base was inevitable to a certain degree. We're certainly going to see that positivity, but it was much more likely to be towards the end of the year. So this new production, this faster than expected return to these output levels is certainly a positive signal for the sector. So next slide, please. Exports, however, is where we have seen, and it's the only metric we've seen a decline in, albeit not a massive decline, a balance of down to minus 8% from minus 5%, which is the penultimate two red and yellow bars on the right-hand side, with the far right ones being expectations. And as I mentioned in the first slide, while it was to be expected that we would see certainly a negative impact to exports this quarter, our data shows that it's been less severe than perhaps other data within the manufacturing sector in terms of exports. But also, critically, what our data shows is that expectations, and these are expectations, I must stress, from manufacturers themselves. It's not our own internal forecasting. We are specifically, do you foresee these export orders within your own company improving in next quarter? And you see that answer on the far right, which that orange bar is positive. So on balance, not hugely positive, but positive nonetheless. And that positivity does indicate that the blip and the negativity we're seeing in those exports, and particularly seeing as the main trading customer for the manufacturing sector in the UK is naturally the EU, that positivity would indicate that this is not a systemic ongoing problem, the loss of trade we've seen in the immediate aftermath of the transition period, and more so it lends weight to the argument that it's the logistical and the novelty of the arrangement that's causing these issues, and that manufacturers in the UK, exporting manufacturers at least, expect this to subside as soon as next quarter. And we'd expect that in Q3 as well to pick up a little further, as well as it makes up for lost time, shall we say, because the presumption is that underlying demand still exists. And the next slide, please. So here we have our typical sectoral breakdown, what we include in this slide. However, it must be noted there are some big ones to mention that aren't explicitly detailed here, which is the other transport sector. And in contrast to the motor vehicle sector, those are perhaps the two most interesting in terms of our research and the size of movement they've experienced in output between 2020 and 2021. Now, in the motor vehicle sector, we saw overall the entire year a huge decline in output, but in 2021, as was always expected, quite a huge recovery forecast as well in terms of making up for that lost output, largely because of the supply chain issues and knock-on effects within the motor vehicle sector, which ceased production so violently. However, it is understood that underlying demand is still there. It's just the supply side issues that have caused those problems. However, the same cannot be said for the other transport sector, which saw a very similar decline in its output in 2020 of approximately down by 25%. But the recovery forecast in 2021, it does not make up for that at all. And so it's going to be a long year for the other transport sector, and they're going to have to stick it out as that recovery for that sector, and it's within the sectors we track perhaps the most severe and most worrying in terms of, while many others are starting to see and get on that path to growth this year, the other transport sector does not seem to be on course to do so. Next slide, please. Now here, this graph is where we show where there is new demand, where that demand has come from. And really the overall takeaway message from this is that it's in the natural hierarchy and historical hierarchy of EU leading the pack in terms of where that new demand's coming from, followed by North America, then followed by Asia. But what's interesting is that we saw in the midst of the pandemic, Asian orders outpace US orders, which we've pretty much never seen in this 30-year research history, 30-year history of manufacturing outlook. And this was because as the pandemic swept east to west across the planet, so an interesting phenomenon where the Asian markets were able to, and Asian industrial production was far more over and dealt with the pandemic and their lockdown measures and so on and so forth that impacted their industrial economy, while the West was getting knee deep in it. But now what this indicates is really a return to that natural hierarchy of where the demand's coming from for the UK, and it can be used somewhat as a proxy for market operationality in terms of their interactions with the UK. So that's an encouraging factor when looking for signs of a return to normality. Next slide, please. Now this slide looks very similar to that first slide I showed you of output and orders, but this is what manufacturers report their expectations for the coming quarter will be. So for example, on the far right, where it says 2021 Q1, that's actually what manufacturers are expecting Q2 of this year to look like. So you see a lot of positivity there. And I must say is that barring crises and sort of sudden freak events, these are very, very accurate at predicting the trend, about an 80th percentile trend of direction of what's going to happen next. And so this is what really underpins, and I'll get onto it in a moment about business confidence, but underpins our optimism in terms of the direction of travel of this recovery, that not only has this recovery come a little earlier than we thought in terms of positive figures, but it's set to continue and not set to be a blip in the dark, with even greater output and orders expected next quarter. And just to note, if you look at the penultimate set of bars just off from the right, that's what we expected and manufacturers expected at the end of Q4, and it was negative. But in fact, what we've received is positive figures. So we've really outpaced expectations, which is a slightly rare thing to occur, but also a positive and an encouraging feature. Next slide, please. Now, the impact of leaving the EU on UK manufacturers is clearly having disruptive effects on the costs of exporting as well as sourcing the same inputs from the block. The combined impact of the new forms, paperwork, taxes, increasing lead times from those logistical backlogs is resulting in a more widespread rise in prices across the board, both in domestic and international markets. And our latest report reported a balance of 13%, which is 13% of those who responded to manufacturers increasing UK and export selling prices over the last 3 months. The higher input costs are partially being priced into new contracts between suppliers, but the total incidence of increased bureaucracy and taxation is being shared most likely between the manufacturer and its customer. And this is reflected in the latest figures for margins, which indicates some improvement on Q4 last year due to improving levels of new work, but remains negative on balance. So quite significant shifts there that we can see on the right with UK and export prices rising, but margins looking to trend upwards somewhat, but still remaining in negative territory where they've been used to now for quite some quarters, as you can see. Next slide, please. To back up all what I've been saying about that future positivity, it really needs to be followed by confidence, and it is. And business confidence is perhaps the most volatile metric in response to these socio-political events. Because in this first quarter of 2021, as I mentioned, not only do we have the expectation that the immediate struggle with the coronavirus will be coming to a close, but it also marks the first quarter in which the UK has left the European Union in earnest. So despite these the sort of uncertain environment, to see confidence rising so significantly across both manufacturers' expectations on UK economic conditions, but also on their own business performance. And for note, the inflection point is 5, so anything above 5 indicates positivity. And so we're quite significantly over that 5 mark, and particularly within the business confidence metric. I should note that those unfamiliar with our research always make a joke, but that gap between UK economic conditions and business performance is very normal because people always think their own business is doing better than everyone else's. So that's very normal to see that gap. But to see both above 5 is very reassuring, and it also adds weight to the notion that this spike in positivity in the metrics we're seeing is consistent with the other views of manufacturers around general UK economy confidence and where we're heading. Next slide, please. Employment is one that remained negative this quarter, but it is expected to turn positive next quarter, as indicated on the far right. Unfortunately, investment didn't quite see that positivity. It's still negative. However, now this research was done just before the budget announcements, but we'd certainly expect that it's up for debate the efficacy of the investment encouraging policies such as the super deduction scheme, but we would certainly expect to see that very artificially boosted come next quarter. So when we come and report to you in Q2, that orange line, I would be pretty certain we would see that rise above the 0 parapet. The question of the size of the spike will be questionable, as there's lots of murmurings about to the degree of uptake of that super deduction, both for whether it makes business sense or whether capital investment plans are just too rigid to adjust them within that 1 year, 2 year window. So the degree of uptake will certainly affect how positive we're able to report those investment intentions next quarter, except I'd be very surprised as you see how close it is to the 0 line and it's trending upwards for it to not be positive come next quarter. However, the long term, with this super deduction and policies such as that solve the long-term systemic issue of underinvestment within the manufacturing sector in the UK? That's another problem, and as such a short-term policy as it is, it's unlikely to do so. Next slide, please. Now, this slide is simply the outputs data we have matched against investment, and I put this here, so we can see the effects of the Brexit referendum and COVID-19 and the interplay between them, but really to say that output that's trailed by investment as it is now, in terms of trending in the same direction, is a good sign, as output without that trailing of investment really does imply some sort of stockpiling or unnatural market effect, which would indicate it's a bubble and not going to be sustained. And so this is a good indicator that the output recovery we're seeing is now what one might call a sustainable recovery, and it's not simply a blip before we dance back down again. Next slide, please. Now, these are our forecasts that have been revised this quarter compared to last quarter in line with many other forecasters. Most significant change comes in our 2021 forecast for manufacturing manufacturing GDP, not UK economy GDP, which is now 3.9. Now, last quarter, it stood at 2.5, and our overall UK economy forecast at 5. So about half as much as recovery as the overall UK economy in 2021. That gap's now closing, with 3.9% recovery predicted in the manufacturing sector, but a slight increase in the overall UK economy GDP at 5.5. However, in 2022, we expect that natural order of growth rate to return, which in any real production or production economies do recover slower than service economies typically and historically than after crises. And that's to be expected and not so much of a panic feature, I should say. But the upgrade of 2021's forecast is a reflection of the better than expected and looking to continue sustainably better than expected performance of the UK manufacturing sector moving into 2021 and throughout the year. And the next slide, please, is the final slide. And this is simply a review of the very first slide I showed you, and then I'll be handing you back to Richard. But just before I do, I suppose if there's one thing to take away from this is that we're outpacing where we expected ourselves to be in the UK manufacturing sector in terms of our metrics. But more importantly than that is the positivity and the expectation for positivity, which is yet to be delivered because come into the year and what really the longer term, slightly unknown impacts are of the end of the transition agreement, and also exactly how successfully we'll navigate our exit from the pandemic. However, it cannot be concealed that the extreme positivity within the sector across pretty much every single metric that we cover, and in terms of business confidence, is shaping up to be what really looks like the start of the recovery with a capital R for UK manufacturing at the end of 2020, and now moving into 2021 as a new year with strong hopes for the sector. So now, thank you very much, and I'll hand you over to Richard.
Thanks, James. As always, both you and Ben, fantastic, and thanks for the update. It's just sort of reflecting on that. It's clear that we are turning a corner, and as you said, sentiment is definitely improving. And to mix my metaphors slightly, we are definitely starting to see those sort of green shoots of recovery. And I think you're right in terms of it being a small R or a capital R. It's definitely directing towards a capital R. However, where there's change and where there are inflection points, there's always opportunity, but there's also risks that need to be thought about as well. And if history is anything to go by, we're not quite out of the woods yet. And the next few months, I think, is going to be critical for the manufacturing sector. So I'm going to hand over to Chris, Jenny, and Steve to talk about some of those key considerations that manufacturers should be thinking about now in terms of what they can do to reduce that risk. So without further ado, I will hand over to Chris to kick off that conversation. Chris.
Thanks, Richard, and good afternoon, everyone. I'm Chris Marsden, and I'm a partner in the corporate advisory team in BDO based in Bristol. Over the last 25 years, I've focused on working with businesses facing financial challenges, and in that time have worked with a wide range of manufacturers, from small owner managed businesses to large PLCs. So I'm very happy to be here today and have the opportunity to speak to everybody. Despite the positive news coming out of the manufacturing survey, our view is that stress and distress are likely to increase in the sector as we move throughout 2021 and 2022. The government measures put in place during the pandemic have worked really well. However, this has to be unsustainable, and businesses will start to come under increasing cash flow pressure once the support starts to unwind. For many businesses, the next 6 months will be critical, and they should be using this breathing space to assess the likely shape of their business as they start to move forward. For those businesses which are likely to face reduced demand, lower profitability, and potential liquidity issues, the time should be used to plan and implement turnaround strategies. Jenny and Steve will cover off some of the practical actions manufacturers can take from working capital and operational perspectives in turnaround situations. But before that, I want to provide a little context as why we think stress is likely to be an increasing feature as we move forward. So the first thing to look at are the historic insolvency rates, as these can be used as a raw indicator for levels of distress. So next slide, please. This slide shows the number of administrations and creditors' voluntary liquidations in the manufacturing sector since 2007. As you can see, 2020 had the lowest level of insolvencies since 2007, which is quite something really, and is testament to the impact of the government support measures. It's highly likely that the levels of insolvencies will increase once the support measures start to unwind. This will be from a combination of catch-up, i.e. insolvencies which have effectively been deferred, and from newly distressed businesses which have been negatively impacted by the pandemic. The final thing I'd like to say on this slide is that historically, there are more insolvencies as economies move out of recession. We can see this by looking at the financial crisis. This struck in 2007 and 8, but distress and insolvencies didn't spike until a year later. If the economy follows a similar pattern this time round, then we can expect insolvencies to rise and perhaps peak later this year or next. Let's now have a think about which manufacturing subsectors might be most at risk of distress. Next slide, please. The chart on the left, excuse me, shows the subsectors which represent 5% or more of all manufacturing insolvencies between 2007 and 2020. In summary, these are food products, machinery and equipment, furniture, repairs and installation, printing, and the absolute standout one there is metal fabricators. Whilst there's no guarantee that the past pattern will be replicated going forward, I think it's really interesting that these subsectors have had consistently higher levels of insolvency than any of the other subsectors. The chart on the right looks at the question from a different perspective and plots the average profit margin different subsectors make against Standard & Poor's view of the speed of recovery anticipated for those subsectors. The sectors in the bottom right quadrant are lower margin and slow recovering, and these are the ones which may be most at risk of distress going forward. These include automotive, metal, shipping and rail. Whilst I think that this is another really interesting analysis, it obviously needs to be caveated, as all businesses are individual and will have their own market, balance sheet and P&L characteristics. So let's now consider when the levels of distress might actually start to increase in the sector. Next slide, please. This chart shows the various government support measures and when relaxation is currently anticipated. By the end of March, the moratorium on winding up orders is currently scheduled to end, although I think this is widely expected that this will be extended, possibly by another 3 months. With respect to CBILS and bounce back loans, these are being replaced by the government-backed recovery loans. However, the timing to note here is that both CBILS and bounce backs have a 12-month interest and capital repayment holiday. Therefore, the start date for repayments is dependent upon when they were taken out. As a result, those who took out loans early in the pandemic will have to commence repayments soon, and perhaps as early as April. Also from April onwards, HMRC deferrals from last year will start to be repaid. This is likely to be a significant liability for most businesses, and many will take advantage of spreading the payments over a 12-month period to ease the pressure on cash flows. Moving to September, the big one here is a cessation of the job retention scheme, which may have a significant impact on manufacturers and may be a trigger for a further round of redundancies. To put this in perspective, as at the 31st of January, there are around 1/3 manufacturing employees on furlough, and that's out of a total UK furlough number of 4.7 million. A further point I'd add here is that the ONS expect unemployment to peak in 2022 at around 6.5%. It's currently 5.1%. Hence, there is an anticipation of further stress and associated job losses as we come out of the pandemic. Also of note is the self-employed support scheme, which it will end in September, and this could have a further impact on smaller businesses within the sector. So pulling all of that together, when might we start to see an increase in distress in the sector? Well, this is a really difficult one to predict, and everyone has a different perspective. However, in my view, we'll probably start to see signs later in Q2, and then see this ramp up as we move through Q3 with the end of furlough. And even then, pressure on cash flows may take a little time to manifest. So it could be Q4 or early Q1 next year when we really start to see levels of distress peak. With that in mind, we're now seeing proactive management teams forecasting the position of their businesses under different demand scenarios, and then developing restructuring and turnaround plans to implement if needed. These plans are financial and operational in nature and naturally have lots of different aspects. We'll cover a few of these now, and I'll pass on to Jenny, who can talk about this from a working capital perspective. Jen.
Thanks, Chris. Good afternoon, everybody. My name's Jenny Schutz. I'm a director in the Corporate Advisory Services team and head up our cash flow and working capital advisory practice. I've been doing this now for approximately 14 years, and prior to that, I worked for BMW manufacturing in both Germany and the United States, and more latterly with the Estee Lauder companies in the UK, so I have lots of industry experience as well. Today, I'd just like to spend some time taking you through some of the trends that we're seeing in terms of businesses' cash reserves and also the working capital levers that can be pulled dependent on how much cash you have in reserve to optimize your position. If we just go into the first slide, please. So here I'd like to pick up on Chris's point, an observation around stress and potential distress, looking at Q3 and Q4 of this year. We've been tracking the Office for National Statistics Business Confidence Barometer, and a particular question around the amount of cash reserves businesses have. So it's 10,000 UK companies, and we look specifically here at the manufacturing businesses. And what this shows is that those companies that are saying they have 1 to 3 months of cash reserves is increased marginally across a 12-month period, but positively those companies that are saying they've got over 6 months of cash reserves is trending upwards. So we've got over 40% in February that say they have 6 months of cash. So this is a good position to be in. While we can see that it's varied in terms of supply chains and risks within supply chains on cash vulnerabilities, there are signs of optimism here. We'd say many businesses probably have this 6-month window to make sure that their working capital processes are optimized. If we can go into the next slide, please. So before I take you through some of the practical actions that you can be making, just wanted to highlight some of the results from a recent working capital study. So as of FY 19-20 end of, there was over £80 billion of cash and working capital sat on UK balance sheets. So this is a large amount. And what we can see is the cash conversion cycle is an average of 60 days. Now, the cash conversion cycle really monitors your effectiveness of your working capital processes. So it's the number of days it takes for a business to convert its inventories into cash from sales. And that had increased year on year going into the pandemic, mainly driven by increased receivables and inventories. So I wanted to spend a couple of minutes just walking you through the end-to-end processes that drive those balance sheet positions. So if we look initially at your receivables, your debtor, what we call the customer to cash cycle, you've got everything from your commercial teams and how they're negotiating with your customers, understanding any credit risk that you have and how that potentially is going to be changing, right through to order processing and making sure you're getting your invoices are accurate and they're going out the door in line with your goods to make sure that the receivables and credit control team are able to process and collect the cash against the invoice. So this is the part that drives drives your receivables position. Then we look at inventories, so stock, anything to do with what we call the forecast to fulfill process. That starts right at the product range management. So what products are you offering? Are those products still required? Is the market still there? Has demand and forecasts changed, and therefore do you need to make any changes to your ordering, your batch production sizes, and right through to inventory management and how you're managing both your raw materials, your WIP, and your finished goods right through to the distribution. So that end-to-end cycle of levers that we can pull is called forecast to fulfill, which then leads nicely on to procure to pay. So what goods and services are we ordering, from whom, with what payment terms are we negotiating? Are they preferable payment terms? Is there any possibility to extend those payment terms? Right through to looking at where invoices are received and payment execution, how frequently you're running payment runs, and making sure that there's controls around cash outflows in the business. So what we can see is it's not just a finance director issue, it's very much impacted by all areas of the organisation, many functions and roles within it. So if we go to the next slide, please. So what are some of the short, medium and longer term actions that can be taken based on the cash reserves that are available to your business? The first thing here I would say is, or advise, definitely to be monitoring working capital as a percentage of revenue or sales, and making sure that any increases in your working cap that's not reflected in your revenue, or any changes in your market conditions, making sure that you're right sizing your working capital, and that's reflected with your sales process. The second thing is around communication. So across all of these short, medium and longer term action plans, communication both with your customers and your suppliers, so external communication will be key, but also internal communication, and making sure everybody who's impacting your cash position is aware of the importance of cash to the business. So some of the short-term actions, a really stable, robust, short-term 13-week rolling cash flow forecast, making sure that the inputs are valid, it's accurate, and any variances are being monitored, and mitigating actions are being developed to monitor your cash flow position. Availability of factoring facilities. Do you have any working capital funding options that you potentially haven't taken before? Is there any invoice discounting that's available to you in the short term? Right through to campaigns around your cash collection. Do you have customers that might be vulnerable, might also be suffering with cash flow issues, that you can prepare a payment plan so you know at least you're getting some of the cash in the business, dependent on what invoices you have outstanding. And I'd say in terms of inventory, looking at the stock that hasn't moved over the last 12 months, are there any options to run an inventory disposal campaign to get rid of some of the stock, even if you take a hit on the selling price of that stock in the short term? Then if we think about medium-term actions, so age debt campaigns, understanding what debt is aging, why it's aging, what the issues are, and who's going to be responsible. So you've got some dates that you can free up that aged debt to feed into your short-term cash flow forecast, but also you can put some mitigating actions to make sure that the root cause is addressed so that aged debt doesn't occur again. I'd say the main thing really around the medium term is looking at your stock position and looking at inventory modeling, and looking at, for example, the replenishment parameters that are in your ERP system that you're driving your stocks, your safety stocks, your cycle stocks. I know, for example, many businesses build in buffers for looking at lead times because potentially there's been historical supplier performance issues. So there's a lot of buffer that's held in the system to make sure that you're servicing your key customers well, but really a granular review of your inventory modeling will be key to managing and controlling the inventory that you have. And then in the longer term, it's more around, so those businesses that have over 6 months of cash, looking at embedding a cash culture. So what governance do you have? Is everybody aware of their roles and responsibilities? Do we have the correct metrics in place to track, right through to incentivization, and making sure that sales teams aren't necessarily just incentivized on revenue and EBIT, but they're also incentivized on cash collection. So there are different levers that can be pulled dependent on the cash reserves that you have available. example, what you can see is that operationally, all functions of your business are going to be impacted by, or are going to impact your working capital cycle. So once your cash is stabilized, there's an opportunity to look at other operational performance indicators that can support cost reduction. And at this point, I'd like to hand over to my colleague, Stephen Cooney, who's going to walk you through some of those. Thank you.
Thanks very much, Jenny. Good afternoon, everybody. My name is Stephen Cooney. I'm a principal in BDO's corporate advisory team. I've got 25 years experience of working with manufacturing businesses, both from a, if you like, a consultants and an advisory point of view, but also from a line management point of view. And this encompasses both small and medium enterprises, as well as some quite large blue chip organizations like Ford Motor Company and Federal Mogul. So if I could have the next slide, please. Thank you. The what the slide is presenting is there's a number of options for turnaround on a business, and that largely depends on the time available to actually enact them, which really essentially means, you know, to what extent is the business going to run out of cash, and how quickly is it going to run out of cash. And so what this slide is illustrating is that there's a varying states of corporate health, all the way from growth through to stressed, and unfortunately on the right-hand side to closure. And there's a number of strategic levers management teams and shareholders can pull to improve the actual cash position in a business. And a number of these obviously regarding raising finances in the business, taking on additional debt, equity funding, etc. But I'm going to talk about today about the ones in the middle, which is the restructuring of existing facilities, and which is really at a macro level, and also some factory improvements initiatives at a micro level to improve profitability and cash. If I could have the next slide, please. Thank you. So this slide talks about macro level performance improvements that a manufacturing business could consider. Now, on the left-hand side, it's presenting and illustrating a typical factory network, a European factory network a business might have. And there might be a number of factories in some kind of high-cost areas in Europe, which might be in the UK and Germany, some lower cost or medium cost in kind of Spain. And then obviously further east you get, you tend to get into the lower cost regions. And so the manufacturing strategy piece is all about assessing how products are allocated to the factories. And even if businesses aren't distressed, this is something that's useful to do every couple of years to assess how do products get allocated to those factories based on volume changes and potential mix changes. And then part of this is considering how could it be done differently? How can you focus some factories onto high volume, low variety, which might lend itself to some more automation, and then also for some low volume factories, which might attend itself to more manual processes or semi-automatic processes, but of course they can be a lot more agile for producing and doing faster changeovers, etc. So that's what manufacturing strategy is about. And obviously when that's done as well, one can also consider the implications on how the supply chain and distribution network as well. So other themes as well coming out of that is considering, you know, the degree of vertical integration you are in terms of producing components and sub-assemblies. And then also considering on the right-hand side, the actual management structure. Now, we've done a number of projects where we've looked at manufacturing strategy in companies and organizations. And one of the things that we've found is that you need some kind of catalyst sometimes to actually have some kind of change. There's often in businesses that have got different factors in Europe, a degree of protectionism or parochial behavior, especially if those businesses are based and organized on a country P&L basis. And so what tends to work well in order supporting a manufacturing strategy piece of work is something where there's one individual that has the responsibility of making product allocation decisions across factories, and like a COO role that is responsible for the entire factory network. And therefore it becomes much easier to make those decisions and enact some kind of manufacturing strategy. Now, of course, all of that, what I'm talking about there, is only relevant if people have got a multiple factory network. I guess what's more interesting, I guess, for potential people on the call of small and medium enterprises is what can be done within a factory itself. So if we could move on to the next slide, please. Now, in terms of looking at kind of like micro level improvements for right sizing a cost base of a factory, there effectively, as everyone knows, there are two types of costs in a business. One are headcount costs, and the other are third-party costs. And so, when we do a piece of work looking at headcount costs, the first group of people we tend to look at are the direct or transactional processing staff. And so, in a manufacturing environment, these will obviously the people actually on the shop floor, the direct labour. But also in back office processes, in finance functions, they're the people that are doing the transactional processing activity of accounts payable, accounts receivable, and also HR functions, etc., etc. And there are a number of levers that management teams can pull to try and assess operational improvements. One is looking at the kind of excess capacity and flexible working arrangements that the direct workforce have. So that's immediately right-sizing the cost base if the volumes drop off, and a number of manufacturers that have done this in the last couple of years, especially after the COVID pandemic, where they haven't necessarily furloughed staff that have taken heads out. Another opportunity is making productivity and process improvements in the business, so through some kind of automation, semi-automation, investing in some new technology that enables you to become more efficient and more productive. And then I guess some other ways of taking those costs out are consolidating functions, if you've got a couple of factories in the UK, or maybe actually offshoring or outsourcing certain aspects of the production process completely. And we always find, though, that often when people look at the actual direct staff, they invariably do not look at the indirect or management structure. And so once you've made the direct costs as efficient as possible, there's often an opportunity to look at the target operating model of the business and start looking at how you can consolidate management roles, delayering management, etc., reinvigorating the different silos that people report into to have a significant impact on the actual indirect and management structure, where normally a higher cost per staff is encountered. Now, on the right-hand side, obviously, a bigger part of the actual cost base is in raw materials, contracted costs, and discretionary spend. Now, in raw materials, obviously, one can go and try and negotiate, renegotiate contracts, etc., with suppliers, but there's a huge opportunity to reduce waste. So, in terms of improving the efficiency of processes, cutting down on scrap levels, etc. Also, potentially, if it's possible, to redesign products, DFMEA, etc., to try and reduce the actual part cost itself. Contracted costs is all about looking and doing a procurement strategy piece and looking at and assessing when were the last time contracted costs like various utilities, other overheads, etc., being put out to tender, changing mobile phone contracts and third-party costs, etc., like that. And the final category is discretionary spend, which is all the stuff that's largely uncontrollable in factories. And it's a question of trying to control that spending and also contracting it as much as possible to reduce the incident of that occurring. So that's a kind of whistle-stop tour of the actual opportunities and strategies and levers available to management teams within a factory. And if we just go on to my final slide, please. This is also just kind of showing you how it can be pulled together. Now, on the left-hand side, we just wanted to illustrate the fact that any embarking on some kind of cost reduction, working capital improvement program requires a different set of skills to managing business as usual. And in our experience, there's typically a three-phase approach to looking at what the opportunity is, planning, and then implementing it. In our experience, a number of projects and programs fail, not because the assumptions were false, but largely because the actual planning hasn't been done properly and there have been insufficient resources available to deliver that change. And how that manifests itself financially is the actual benefits are either delayed or the actual benefits aren't as achieved as expected. So in our view, every single kind of management team in a manufacturing business should be going out there and looking at the opportunities they've got. What is your plan B if your volumes fall off? And also, if you're experiencing a growth phase, making sure you've got sufficient working capital to actually fund that growth. So there are plenty of opportunities to improve cost and cash, and typically a diagnostic piece of work, right, should take a management team no more than 2 or 3 weeks to do if you know your business very, very well. And the first part of an output of a diagnostic opportunity is looking at the type of projects. And this is just an example of a piece of work we've done. We're a 3-factory business making woven fibre. We supported the management team over 3 weeks. That was a distressed £100 million turnover business. Very quickly identified over £3 million of profitability improvement by implementing 11 projects. And the key thing before embarking on that implementation phase is to have some kind of understanding of a roadmap as to how this change can be implemented and in what order. So this kind of chart on the right-hand side illustrates, where's your biggest bang for your buck and what's the easiest of things to actually implement. And that gives you some kind of prioritization matrix in order to implement this change. I hope that's given you a kind of a whistle-stop tour on some of the operational restructuring levers that you can pull in the business to improve your factory or your factory network. I'm now going to hand over back to Richard just to conclude this section. Thank you very much.
Thanks, Chris, Jenny, and Steve. Just sort of reflecting on that there's, I think the message there is there are a lot of moving parts. So, there are things to think about in terms of employment, in investment, which James picked up on, and inflation as well, especially in the supply chain. And also, we're all hearing about supply chain lengthening as well in terms of the time it takes for products to be imported and exported out of the UK at the moment. And that clearly has an impact on working capital positions and cash, and also raises the question of whether your operating model is as optimized as it possibly could be going forwards. If you overlay that with what Chris was talking about in terms of government support, that's not going to last forever. And manufacturers really need to ensure that they are as fit as possible over the next 6 to 12 months, so that when those measures start to be wound back, that they're in as fit a position as possible to take advantage of an economic recovery. And then in terms of that, I guess the other thing to think about is you need to be planning now. You really need to know what your situation is, and you need to be planning now, because those government loans, etc., will be pulled off the market over the next 12 months. So really start to consider what initiatives should be implemented now to de-risk your recovery plan and to ensure that you're as successful as you possibly can be as the economy recovers. With that, I will hand over back to Bal to take any questions that you may have. Bal.
Thank you, Richard. So we've had a few questions come through, and Ben, I'll pose the first question to yourself. Has the end of the Brexit transition period hindered or helped long-term COVID-19 recovery strategy?
I think it's a really interesting question, and I mean, I found the last few minutes absolutely fascinating in terms of the really high quality analysis that we've had. And I think, sadly, it's one of those questions that doesn't lend itself to a simple yes or no answer. I think the end of the transition period, in its simplest form, has created barriers to trade. And barriers to trade always bring about additional cost, additional complexity, and by the very definition of the word barrier, they make business harder. So if you are an exporter and if your primary market is the EU, I think that has made trading more challenging at a time when you may be actually really struggling after a very difficult year. Equally, as James set out earlier, confidence is under the circumstances very high, and confidence is growing. So I think that at face value, it is inevitably going to make it harder for people who are trading with the EU. But actually, I think at the moment, in terms of the analysis and the confidence that people have, it hasn't had the impact that we may have thought it was going to have. One of the really big issues, and I sort of categorized this earlier in 3 chunks, firms that have got over that barrier, firms that are going to get over that barrier in the end, and firms that are having to look again at their business model. It's going to be how big is that third group? How much of an impact will they have across the economy on people who supply to them, people who are their customers, and what will that mean in the context of COVID recovery? And it will be the gap, I think, between where we were 12 months ago and where we are in 6 months that will ultimately define that question. So ultimately, barriers are never great for trade, but at the moment, confidence seems to be higher, and there is a greater degree of optimism than we would have anticipated.
Thank you, Ben. And James, the next question for yourself. Which end market sectors are expected to have high natural market growth in the medium term, and why?
Again, it's a very good question. I would say it's a challenging one as well, given the use of the word natural in a period where it's very hard to separate the effects of everything that's going on, and more specifically the pandemic than the end of the transition period, in terms of where that medium-term demand is growing. I can certainly offer up a sector that we've heard from a lot, both anecdotally and wider discussions with our members and other such groups and committees. The demand is growing and is set to continue, and it's sort of established itself. It's questionable how natural it is, because it has certainly been catalyzed by the pandemic, but that's in companies that are involved in the production of fourth industrial revolution related technology, such as cobotics and the like, and particularly those companies who offer relatively low cost entry interventions, so such as those as Internet of Things, relatively simple but very efficient stock taking software mechanisms and technology. And this is really because COVID has really highlighted to these customers of such products that the year of the labor force pressures that have arisen have sharpened their minds, and they now not only see the benefit of these technologies in a normal season, but can also now value the resilience they provide on their production line in cases such as the circumstance we find ourselves in, and it will also offer them that resilience going forwards, as we've certainly learned over the past year that we're never really quite out of the woods, and every time we think we're out of the woods, it's never too late to invest in such resilience enhancing technologies within your business and production line. It's questionable if that can be assigned the natural moniker, as it's certainly catalyzed, but I wouldn't say, to not be obtuse, certainly what's not natural would, let's say, the expected uptick in recipients of capital expenditure that we would see in the mechanical product sector, which we could definitely assign in the next few years to various investment motivators, which would perhaps fall foul of that natural moniker. But I hope that goes some way to answering the question.
Thank you, James. And we've had another question come in, which is subsector specific. So the automotive sector is currently going through a period of change and faces a number of challenges over the next few years. What do the panelists think are the key opportunities and threats for the sector? If I open that up to the BDO panelists first.
Who's going to take that one? Shall I speak on that one to start off with?
Yep.
Okay, I mean, I think one of the issues, and certainly that chart that we put together in Chris's slides, if you look at the automotive sector in the UK, the average profitability a couple of years ago was about 5% EBITDA margin. So that's kind of profit divided by revenue, compared to something like tobacco, which is at 18%. And so I think one of the issues that they've got, if there's a normal distribution curve of all the companies in that sector and the average is 5%, there's already going to be a number of distressed companies to start off with. And obviously the automotive sector's had a large number of challenges. Not only has it had to deal with Brexit and it's going to be dealing with the rules of origin, there's going to be a seismic shift in the change in the use of the internal combustion engine. I think something like 90% of vehicles sold at the moment have a nice internal combustion engine. Towards the end of this century, the SMMT think that's going to be significantly lower, and the government have changed the legislation as well. So there's going to be a number of changes and challenging that industry is facing. So I think from an opportunities point of view, in order to meet the rules of origin, there's going to have to be a significant investment in battery technology. I think the Faraday Institute are thinking there's going to have to be something between 6 and 8 gigafactories launched in the UK in the next 20 years. That's a fantastic opportunity for manufacturers. But I think on the downside, there's going to be a number of manufacturers that are actually sitting in the, you know, going to be fair. If you're a company that only supplies the internal combustion engine parts, then I think you're going to be in a bit of a challenge. And there's also going to have to be some kind of refocus of your business to survive in the long term. So I guess that's my thoughts. Richard, have you got any thoughts to add?
Yeah, I totally agree with Steve. I think it very much depends on where you are in that supply chain and what sort of products and services you're actually supplying into the automotive sector. So there clearly are going to be some big winners out there. The question is how much investment and support is actually going to be provided to those businesses that are potentially more agile, which kind of goes back to what Ben was saying about an industrial strategy and how clear that is, and whatever replaces it, how clear that is, and how much is put behind it in terms of political weight and longer term investment, because it does require that. So I think that's one thing, but I totally agree with Steve. At the other end of the spectrum, if you're making car gearboxes or clutches right now, or anything to do with that, then that's not really a place you want to be in, and you need to start thinking about how you pivot your capability potentially around your engineering and design to alternative models. You know, potentially looking at things like wind farms and all kinds of other opportunities where similar technologies could be applied. So I think it's again, it's difficult to look at it even from an automotive broad perspective. You need to look at it at a one level down from that to really understand where the winners and losers might sit.
Thanks, Richard. Ben, James, anything you'd like to add to that?
I'll go on to say that that really to highlight what our BDO colleagues have been saying, that it's going to be that one down on the supply chain, not the finished good manufacturers. They're going to really have to think during a period of unfortunately very pressured margins amongst somewhat contributed to the input cost pressures from the new arrangements with the EU, but also that they need to think about how they're exactly going to pivot that production under those intense margin circumstances, because it's going to be those down on the supply chain, and as has been mentioned, those in that exclusive supply chain around the internal combustion engine that really, you know, already as of perhaps a year ago, really want to be thinking of the future of automotive in the UK. How are they going to take those very long developed skills and expertise within their production, and how they can use those and transfer that knowledge and skill forwards, because it certainly is definitely applicable to the new future of the automotive production sector. But it just needs to be very actively managed going forwards to really capitalize on the success that stands there to be taken within the UK future automotive manufacturing industry.
And all I would add is I think, without predicting how this will go, what I would say is that for many firms, there is both a double challenge and a double opportunity. The challenge is, as being set out, you know, a radical shift in what the market will need, what kind of product you're producing. But I also think for many firms, the firms that are most likely to be successful is simply not about saying, I'm going to stop producing gearboxes and start producing X instead. It's also, is this the opportunity for me now to also embrace digital technology, robotics, artificial intelligence? And I think the successful converters will be the firms that are brave enough and in a very difficult time have the pockets that are deep enough to enable them to take both of those challenges on. And I think if they're able to do so, I think Britain will still continue to have a very strong industry, and in many respects could be a world leading industry. But I think this is both about changing a mindset, changing a product, and also changing the way that you operate. And I think that's where success will come from.